In this video, you are going to learn the difference between retail and institutional trading and chart techniques to find trades with smart money concepts. Let's start. Welcome traders, I'm Juan Maldonado, professional trader with over 15 years of experience, founder of ElliotWaveStreet.com, and we are going to talk about today the retail and institutional trading. It's a concept that is going to change completely the way you see the markets. So let's start with the institutional part. Institutions, we have a lot of institutions. We have small institutions, we have medium institutions, we have large institutions. But the ones that we really need to understand their behavior are the ones that manage most of the volume of the markets. So let's start here with this article that I found. I'm gonna leave you the link in the description of the video in case that you want to research a little bit more. But look, in terms of the Forex market, and of course it's gonna be similar for any market, of course different institutions, but it's gonna be similar. We're gonna have a big guy on the crypto market, on the stock market, on the futures market, on the options market, on the currency market, on any market that you can imagine. The big guy is the one that is behind all these transactions. So in this example, on the currency market, on the Forex market, as you can see, these 10 institutions that we have here are providing the 64% roughly of the volume on this market. That's crazy. And these are the ones that are making money. So we can say that all the other institutions and individual persons trading the markets are the rest of the percentage out of these 64%, which is crazy. So this set of institutions, I call them the big guy. The big guy is the set of those institutions. And the big guy is the liquidity provider. And the big guy is the dealer of the market. The big guy is the one that makes most of the money of the market. On the other side, we have the rest of the participants of the markets, so are the retail traders. The retail traders are the ones that are losing almost all the time. We know that from 10 traders, 9 are losing their money. So this is huge. So the difference we can see in terms of the business is that the big guy is going to absorb all the losses from the retail world. Imagine where you have a business where all the losses that the other participants are having are going to your pocket. Wow, that's a great business. So you have to make sure as the big guy that the market is difficult to trade, that the traders are trading on levels that they are going to lose their money, that you can shake out the markets to take all of them out, to take stops, to stop hunting, to make sure that no matter if the trader is long or short, to take them out. Of course, that's the best thing for the big guy. So one of the things that we can see in general terms of the retail traders is that they are always selling when the market is low, when the market is cheap, and they are buying when the market is expensive. And in this video I'm going to show you why and how the classical indicators or technical analysis tools are always making you sell cheap or buy expensive. Let's imagine that you have a business in the Central Park, that you live in New York City, and you have a business, you want to start a business selling ice cream in the Central Park. So you ask for a permit, and you are gonna have your ice cream car somewhere here in the Central Park. And you are pretty excited about starting your business. So the first thing you do is you are gonna find a dealer to have ice cream, to get ice cream. And let's suppose that you are completely new in the business world and you go to the most expensive market of the city and you buy each ice cream at $10, and then you come back pretty excited to your ice cream car in Central Park and you start selling ice creams at $5, losing $5 per unit. And at the end of the day or at the end of the week, you are going to have a huge loss because you were buying expensive at the most expensive price and then you were selling cheaper. Of course, this is a huge mistake, and it's something that if you are trading ice cream, or if you are trading the markets, or if you are trading rice, or anything that you can think about trading, is always the other way. You need to buy cheap, let's say buy each unit at $1, so you need to go to the wholesale guy and buy the ice cream and then sell it at a higher price, and that's the only way of making money. But as I'm going to show you in this video, the retail traders are doing the business all the time the opposite, and most of them are not even seeing that they are trading like that. So of course this is great for the big guy to have the traders trading the other way, because of course all the losses that they are having are going to the big guy pockets. So one of the key difference between the retail and the big guy is that the retail trading is always buying too late, is always selling too late. And in this class, we are going to talk about techniques. To avoid that, I'm going to show you simple techniques to start trading in the right levels. So let's start. Okay, traders, here is the first technical concept. So the main plan is that we are going to find trades in areas where the market is cheap when we want to buy, and when the market is expensive, we can sell. So let me start explaining the areas. This is gold, and these techniques can be applied on any time frame and any market. You can trade individual stocks, you can trade Forex, you can trade futures, anything that you like to trade. The same techniques are going to apply on any market. So randomly I picked gold, and of course this is going to be the instrument that we're going to make some exercises here during this class. Let's start. Let's start with something basic. If we have this sequence, higher highs, lower highs. So this sequence is telling that the market is in a bullish trend. And the first concept that we are going to apply here is finding where the market is cheap and where the market is expensive. So one of the things that I made for my students is to imagine a center line of price on the trend, and you don't need to be precise. You just need to add a center line, and no matter how you draw it, you can draw the center line here, or you can draw the center line here, or you can draw the center line here. Okay, it doesn't matter. Just try by roughly draw the line in the center of the price. You don't need to have a special tool. You don't need to have a special technique to draw this line. Just roughly try to draw a center line in the price. So when you have this line, we are going to call it the fair price. This is the fair price of the market. So when the market is expensive, it returns back to the fair price and moves far from the fair price and is cheap. When the market moves up, is expensive, back to the fair price, is cheap. The market moves back to expensive, back to the fair price, and then is cheap. And here, when the market is expensive, we're expecting the price to return back to the fair price and probably far from the fair price, and then will be cheap. So traders, if this is the ice cream example, we want to buy at the lows. We want to buy from the wholesale dealer, and when the market is expensive, we don't want to buy it. So listen, this is of course logic. It comes with a lot of logic and it's simple, but also imagine any retail trading technique, a moving average crossover system. So let's suppose that the price before was selling off here, was moving down, and eventually turned it up, and you are looking for a moving average crossover system. So you are going to add any moving average, a fast and a slow, any number that you like. And the fast is going to move here, near the price. It's going to start turning with the price, is going to start turning with the price, is going to move with the price. And then let's add the slow. So let's say that we are working with a 20 EMA and a 50 EMA or whatever number that you like. So this is the slower moving average, and here they cross each other. A really popular technique among technicians is buying when we have a moving average crossover. If most of the times when that crossover happens, you are going to buy at the candle close, whatever, so you finish buying here, somewhere here in this area. And your stop loss most of the times is going to be either below the EMAs or below the previous low. Having a huge stop loss and buying expensive, buying above the fair price. And that's what most retail techniques in the charts are going to provide you, a late entry. And that late entry is making you buying above the fair price, buying near the expensive area, buying at the worst price possible. When you apply this technique, you are trading like the ice cream guy, selling the ice cream at a lower price than it was possible to be bought and losing money. Trading like that comes with a lot of trouble, because even if we don't talk about results, if we just talk about the logic of the business, that's crazy. When you are trading, you can't be buying at highs. That's absolutely crazy. When you are a trader of cars, of ice cream, of iPhones, or whatever, you need to buy cheap. That's the main logic. So of course, all these retail techniques are going to make you trigger your trade extremely late when the market is already expensive, when you need to have a huge stop loss. And of course, that's fantastic. You know for who? For the big guy. The big guy will be extremely happy seeing you trading like that, because he knows that you can have a couple of good trades during the road and probably make money in one trade. But he knows that if you continue trading like that, rather sooner than later, you are going to lose everything. And if you have a 20K account or a 100K account or a 1000K account or whatever number, at the end, that money is coming to this big guy pocket. So, of course, the big guy loves retail traders and retail trading techniques. However, in order for the price to move, the big guy needs to start something called a campaign, an effort, or whatever name you want to call it. And he starts the process earlier. He starts that process by doing accumulation of the contracts near the turning point. So actually, the thing that you need to master is turning points. But let's continue with the logic of the market. So the next thing, traders, is when the market is sideways. Well, first of all, before we close this little concept, from now on, you need to target, you need to find ways in your career to buy as soon as possible near the low of the market. If you want to sell, the closest as possible to the high of the market. Of course, here on Elliott Wave Street, we teach every day those techniques. On the membership, you can sign up and you're going to learn about price action and Elliott Wave, of course. But let's continue here with the exercise. So that's about the trading logic of the trend. Now let's make an exercise with the sideways market. When the price is sideways, traders, is the most important part of the process, because when the market is sideways, we can call the sideways market as a balance market. We can call it the process where the big guy is doing an effort, is planning something. So to keep things extremely simple, traders, when the market is sideways, is in balance. And when the market is in a balance cycle, is where the big guy is planning his next move to build something here in order to stop hunt and make sure that he's going to take out as many participants out as possible. Let's imagine that you are short in this process. So all the retail techniques, well, first of all, let's imagine a 50% line inside this box. You don't need to be precise, roughly. So we know that this will be the fair price. And if you want to learn more about the auction, we also have courses about the volume profile inside the Elliott Wave Street membership. So fair price, expensive, cheap, expensive, cheap, expensive, cheap, expensive, cheap, right? So of course, all the retail trading strategies are designed to bring sellers into the lower area because the moving average that they are trading, because the price was breaking down a support, because the Bollinger Bands are turning, or because a candle closed below the Bollinger Bands, or because they are seeing bearish momentum, or because they were seeing a divergence before, or any form of retail techniques that you can imagine. So if you sell here, let's say, where do you place your stop loss according to the retail books? Well, somewhere here above the high, right? Some traders will add some points. Some traders will place the stop pretty tight above the high. Some others will leave it a little bit higher. So the big guy knows that. And in this process, let's suppose that the market comes up here and takes out everybody in this market cycle and then rejects. Have you seen this pattern? Yes, of course, all the time, right? All the time happens. And that's when you were selling here and you got stopped out here, and after that the price actually moves down, you're going to say, oh, how is that possible? I need to trade without the stop loss. Because always when I leave my stop loss, is like someone is going for my stop loss. Yes, because you were trained in the retail space and you are doing the same as the others. You are doing exactly the same as 90% of the participants are losing their money, and it's easy for the big guy. So when the price comes there, it stops hunt everybody here. Imagine the ones that were buying. Now the other side. So we probably have buyers here. Always the retails are buying expensive. Or the ones that were looking for the breakup are buying here. Where do you think they are leaving their stop loss? Well, clearly under this area. Somewhere here, right? So the price takes them out as well. So this is a process to take out both sides of the market. And the big guy makes a lot of money during this process. And at the end, the market runs in one direction. So the plan of the big guy is to make sure that 90% of the other participants are losing their money. That's why he's not going to make things easily. That's why you are not going to find a magic formula to make money in these markets in an easy way and become millionaire in a couple of days or in a couple of weeks, or that PDF that you're going to buy in the internet to make money, or that robot or that AI technology to make you rich. Of course, is not going to work, because all those tools are just for the ones that are selling those tools, that are selling these courses, just to make you waste your money and of course your time and more money, because you are applying techniques that clearly don't work. So it's time, trader. It's the time for you to start changing your mind. I call this program like a detox, a detox for retail traders. My clients come with a lot of bad habits, and of course it's a process to clean this way of thinking. So traders, now let's talk about the right way of thinking. Let's make the same exercise on a balanced market with an institutional logic. So let's suppose that the market is again in a balanced area. And when the market is in a balanced area, that the big guy is planning something. The big guy wants to do something. The big guy wants to create later an imbalance. So if you are short after doing your analysis, let's suppose that we are doing Elliott wave analysis, and we are saying that this is a wave 3, and that this is a wave 4, and that this is a wave 5. And let's suppose that we want to short, that we are finding the end of the trend of this market cycle, and it could be on any time frame. So here, traders, what we need to do is finding the trade near this side of the market. So if this is the fair price and I want to short, I need to sell in this area. I need to sell at this rejection. Hint, we can wait for a candle to close under the wave 3, and that's our trigger point. If we are right, the price, let's say, that makes here the wave 1, the wave 2, and moves down, and we make some good money. If we aren't right, we'll still have a chance of being safe. Let's suppose that in our short trade, we leave a protective stop loss some points above the high, and this is our entry point, and this is our risk. 1% or less, let's say 30 points is the distance, 20 points, whatever. When the price comes to the fair price, we already reach a 1-to-1, risking 1, making 1. Right there, we can book profits. At this stage, right here, we have a 1-to-2, 2%, risking 1, making 2, we already book some profits. So at this stage, if we have the rejection, if the price fails to break down, we can book all the profits, or if we still think that the price is going to continue, we can tighten the stop loss to the break even, let's say. So we are safe. If the price comes up, we don't care because we already have a successful trade or as a break even trade. In the meantime, remember that the retail trader is selling here. He's selling at the worst price possible. And at that level, even if our analysis is right or not, we're making money or we are safe, while the retail trader is in trouble. As you can see, applications of the Elliott wave theory can be different. But if we start thinking from an institutional logic, not trading like the big guy because that's impossible, but following his footprints, following his steps, understanding the levels, your business will change completely. So traders, this is extremely important. Never in your life sell cheap. Oh, but I need validations. Yes, you need validations, but you need to improve those validations in order to trade closer to the high. If you wait too much time, nope, you are late. Of course, another technique that we teach in Elliott Wave Street is trading the trend rate, and is after the ABC, we can sell it. But of course, that's something that you can learn in the Elliott Wave Street membership. So let's have a look some examples in this chart. In this chart of gold, we have a cycle here. So we have a high, we have a retrace. We have a high, we have a retrace, right? So we can imagine a center line in this first cycle. So we can start seeing that this is expensive and this is cheap. This is expensive and this is cheap. Now with the logic that we just went through this lesson, now you know when the market is cheap equals you are going to buy it or do nothing. When the market is expensive, you are going to sell it or do nothing. Because most of the times, the beginner will read this class in the wrong way and will say, okay, those are entries, and we are not talking about entries yet. We're just talking about areas. We are just talking about key areas where we can follow the price, where we can enter the price. So for example, in this area, now you know that the only thing you need to do is go in short or do nothing. So you can now use your tools. And if right there, the EMAs that you follow were switching, were crossing each other, you know that you can't buy there. So it would be a do nothing, let's say. So let's draw again the center line here. And as you can see, the center line can be drawn on any taking care of any points or whatever. You can draw it like that, or you can draw it here, whatever. You know, we don't care. Usually the beginner wants to learn how to draw lines and spends a lot of time taking care of how to draw lines and how to, if to use the tails or if to use the bodies, and of course that's a waste of time. So fair price, remember, this is the fair price. If your bias is to buy it, you have to buy it far from the fair price. let's have a look at a specific trade in this area. So we have a trend move that looks like an impulse. It could be in Elliott wave, wave A, or wave 1, and that's your impulse. Now you wait for a clear 3-wave sequence to happen. So here you have an ABC. Now you have that reference point of cheap and expensive. The next step in the process is finding a rejection, and right here you have your rejection. So we got the price building a corrective, bigger corrective than anything else during the C leg, and then we got an attempt to continue and we got rejections. That's a first entry. A second entry could be the trend trade here when the price builds wave 1 and wave 2. But the advantage of this technique, and of course in the Elliott Wave Street membership you are going to learn more about these specifics of the entries. But the key thing here, traders, is that we know that the only thing we can do here is going long. We can only buy here. We can't sell. If you think that the market is going down, you have to sell it here, or you have to sell it here, far from the fair price. If you are wrong because the price continue higher, at least you have time to book profits and have a safe trade. But of course, if you sell here at the extreme, you are too late, and this is not likely to work over time. Even if in this case, let's suppose that the price sell off and you have a good trade, over time you're gonna lose your money. Now, when the price becomes expensive, so here, or here, you have to be extra careful. Right there you can start thinking, okay, so I can draw a line here, and I'm seeing rejections, so this is time to close my buy trade, and if I want to short, that's the time. That would be the first sell signal. Probably could result in a loss, well, when the price moved here, or probably you got a 1-to-1, depending on the size of the stop that you were using. But here you already make some good money. So of course, not all the trades are going to work. Right here is your second entry. You will be trading against the trend when you sell expensive when the price is going up. And if you want to go with the trend, you have to buy on the other side. So the next entry here when the market was cheap, is here. This one is pretty clear. A, B, C, rejection, entry number 1 or entry number 2. Again, this video is about the logic of the big guy and how to follow the big guy. It's not about specific entries. For that, you can learn more on the Elliott Wave Street membership. Now, this is also a balance area. It's a trend trade because the market is reaching higher highs with higher lows. But at the same time here, we got a box. We got here a balance area. When we have a balance area, traders, now we can add a 50% line here. And the retail trader is going to wait too much for buying, and that's a mistake. But inside the sideways range, we know that this was cheap, this was expensive. The center line here is the fair price. The price comes down here to the low side of the box, and look what happened here, is rejecting in a cheap area. If the price was likely to sell off, then we will have follow through, we will have red candles, something that never happened here. So you can see the rejection, especially after this green candle, that the green candle that was able to close above this area is a key candle, because it's showing that the big guy is adding demand, is reducing supply at the low side of the box. So you have to buy it there. If you are with a short bias, because you can be with a short bias, and you think that the price is going down from this high, then you have to find a way to sell it here, or sell it here as we just mentioned with the rejection, right? But those are the selling points. And when you see this rejection here, you have to close your trade, or you have to tighten your stop loss, because you know that the demand is building on the other side. So of course you can change your bias during this process. And of course you decide the turning points. But of course, if you are trading as a retail trader, selling here, because the price is breaking down the previous low. That's a huge mistake. And of course, eventually you can have a good trade, but most of your trades are going to result in a loss, and you're going to be losing your money, probably having a good trade and then losing money, as 90% of the retail traders. So the only way, traders, in order to have a good business in terms of time, having a successful trading business, traders, is to think on the other side. The guy that is making the 90% is the big guy, is the market maker, is the dealer, is the other time frame trader, whatever name you want to call him. So don't you think that it's smart to try to follow this guy and not following the crowd, following these retail techniques that don't work, following these EMAs, following these indicators that don't work? When you understand the logic of the big guy, then you can start applying these indicators in a different way. And that's where you're going to say, oh, okay, I got it. But of course, you have to understand deeply the way that the big guy works. And it's the same thing as the smart money concepts. When the big guy is doing an effort in the balance area, it's the smart money, because the big guy is the smartest player on this market. And of course, he's building something. And some traders believe that the result is being built during the result. And that's a huge mistake. The big guy was building this move up from here by increasing demand, absorbing at the lows. The big guy is a great trader, so he's going to buy cheap, and then he withdraws the supply liquidity. So when there is no enough supply, the price starts moving up really fast. The big guy, as we can see here in this box, was absorbing all the buyers. Here we have a lot of stops. Here we have more sellers. Here we have more stops. And the plan at the end is to make sure that 90% of the participants are losing their money. So of course, it's time to change your trading forever. If you want to learn more about this technique, you can sign up on ElliotWaveStreet.com. Let me show you. We have a fantastic membership with live market analysis. So right here on ElliotWaveStreet.com, under the membership tab, you can start. We have the Forex, the stocks, or the full access plan. There is a special trial, $19 the first month. You are going to see in action all these smart money concepts Monday through Friday on the live markets. I'm going to show you the precise trades each day on these markets, the cycle that we are in, and how to trade it, and what is likely to be the plan of the big guy for that week, for that day, for that session. Also, you are going to get access to the education, a huge library of education with the volume profile course, the candlestick course, the Elliott Wave crash course, and more. You're going to get a lot of education. Everything is to spot the levels where the big guy is acting. So I'll see you inside the membership. Thank you very much for watching this video. Don't forget to subscribe to the YouTube channel, to like this video, to share it with your friends. I'll see you soon. Take care. Bye-bye.